and welcome to this Royal Economic Society policy webinar on monetary tools. My name's Chris Giles, I'm the economics editor of the Financial Times, and I'm delighted to be joined today by four eminent academics who are going to be talking about monetary policy in the era of coronavirus. It's certainly the case that we thought maybe that monetary policy was out of ammunition or close to out of ammunition before the crisis started, but there's been quite extraordinary activism in developed markets and in emerging markets in the past 3 or 4 months. So we are genuinely in a new era for monetary policy. So I'm delighted to be joined by an expert academic panel. In the order they're going to be speaking, we've got Paul Tucker, a Harvard Kennedy Fellow, Research Fellow, and author of the very widely read book, Unelected Power. Willem Bouter, visiting professor at Columbia University. Tatiana Kirsanova from Glasgow University, and Roger Farmer from UCLA. You will have a chance to ask questions, and please do ask questions. And if you do them, please email the questions to webinar@res.org.uk, and this address is going to come up in your chat function on this webinar, should be up just as Paul speaks. So with no further ado, I'm going to hand over to Paul Tucker because I'm going to be very strict with timings. Paul, the floor is yours.
Chris, thank you very much, and thank you very much to the Society for asking me to join this. For once, for the first time in a long time, I'm going to say a few things about the UK. First of all, I think that more or less everywhere across the advanced economy world, the public finances are going to be central to how monetary regimes evolve over the next few years. Before this latest crisis, people were thinking that fiscal policy would bear more of the brunt over future recessions. But it's quite possible that fiscal policy has shot most of its capacity already during this crisis and what remains of this crisis. We're also in a situation where monetary regimes had not been tweaked or updated before this crisis. This places central banks in a peculiar position. I think it's only a bit of an exaggeration to say that in the United States and in the Euro area, the Fed and the ECB effectively are the economic government. In the UK, the question is whether the Bank of England still exists and whether it's actually now reverted to being the operational arm of the Treasury. And this issue has arisen because of the difficulties of delineating what is monetary financing and what is not monetary financing of government. So if you look at the actions to buy vast amount of bonds over the past few months, I think it's not completely unfair to say that the purchases were on a far greater scale than would be needed to maintain liquidity in markets. They weren't a classic market maker of last resort operation, but also they came too early, really, to be easily identified with stimulating aggregate demand, since after all, the productive capacity of the economy was being closed down. So this is a world in which communications are all, because anything that is done that truly in the spirit of the Monetary Policy Committee's mandate can be written up and perceived as something that is just helping out the public finances. One small measure I would take if I were the Bank of England is I would reverse the renaming of the inflation report. When it was rechristened as the Monetary Policy Report, that invited everyone to think, oh, well, monetary policy can be used for all sorts of things. So is it still being used exclusively to pursue the inflation target? So I hope if anybody from the bank is listening, just get on and revert to the style of publication and the style of communication that you had in the past. The second thing I would like to say is about instruments versus targets. There is a debate going on about how on earth is monetary policy going to be able to cope, and some people promote new instruments and some people promote new targets. And it's vital to distinguish between the two. It's too frequently said, oh, expectations do all of the work in monetary policy. And therefore, if only we can redesign the regime, expectations will get us back to a better state of the world, higher inflation and better growth. Well, expectations only do any work if the instruments that we're using have a potent hydraulic effect. And this is why the debate about negative interest rates is so important. My best guess is that the UK won't lead on that, but the question is whether they will follow the ECB in pushing rates down both to where they are at the moment, I think -3/4 or maybe more than that in the euro area. And it will be very interesting to see if the ECB over the coming year or so actually push into more negative territory and become the great innovator in monetary policy. But the final set of things I want to say are about the debate that has just arisen about nominal GDP targeting. The first thing to say is that nominal GDP targeting wouldn't give the central bank any more instruments at all. It would be a reframing of the objectives and the targets. The second thing to say is, and I've thought about this a lot over the last 36 hours, that a world where the Treasury sets the nominal GDP target, which is what it would involve in the UK, is the world where we could see the kind of cheating that went on with monetary targets in the 1980s and earlier than that. And let me give you two examples. An NGDP target is typically set as a sum of the rate of inflation you want on average, plus what you think is the underlying trend rate of growth. Well, no one's got the faintest idea what the underlying rate of growth is now. So let's say it could be 1% or it could be, say, 3%. That would be a bit high. So one option is to set an NGDP target of 1%. And imagine that that's not a bad guess in the short run, but it becomes apparent that actually the trend rate of growth and the capacity in the economy is expanding greater than 1%. So then the Bank of England will be faced with raising interest rates that choke off recovery so as to comply with their 3% target. Or the Treasury will be faced with the choice of amending the target, raising it during the course of the cycle. That's the kind of thing that used to go on with monetary targets. So anticipating that kind of problem, I would guess it's more likely that the Treasury would set a target of, say, 5%, 2% for inflation and 3% for underlying growth. But what if it turns out if, after all, the underlying rate of growth is only 1%? Well then, if the Bank of England succeeded in generating nominal income growth of 5%, we would see inflation going up to around 4%. Now, maybe there are people advocating this who would think, oh, that would be quite handy because it wouldn't have been expected and it would inflate away of some of the debt. Well, all I would say to that is that eventually the rating agencies would anticipate this, maybe even downgrade sterling sovereign ratings, and the market would respond adversely to it as well. The playing around with targets is typically a short-term game that only works for a short time, and then actually everybody regrets it. And the United Kingdom lived with that from about the mid-1970s to the mid-1990s. And I hope that the debate around changing the target is a mature one. And actually, I hope the UK doesn't go first. It never has on anything else that matters in monetary policy. And it's too big and it matters too much for us to be the experimenter. Thank you, Chris.
Thank you very much. So thank you very much, Paul. I think my video is off. It's now a great pleasure to ask for Willem to speak next. Willem.
Good morning, good afternoon, wherever you are. It's an honor and a pleasure to be able to speak at this event. I basically want to argue that we are witnessing the end of central bank independence because central banks throughout the advanced economies have become not just fiscal agents for the government, but in some cases fiscal principals. And that role is without legitimacy and will have to be changed by making the central bank an explicit fiscal subsidiary of the Treasury. Like Paul, I'm somewhat surprised at the unwillingness of central banks to use their traditional instrument. I mean, the size and composition of the balance sheet, quantitative easing, have exploded. And I don't think there's anything wrong with that, as long as you have proper accountability, which you don't have. But as regards interest rates, the ability to go seriously negative is there for central banks to take. So they can either introduce a variable exchange rate between currency and deposits. They can tax currency in the spirit of Gazelle, rather clumsy, or more easily, they can abolish cash or currency and introduce a central bank digital currency for everyone and everybody. Even the ECB, which is minus 75% deposit rate, is, I think, a poor runner in this race because it should be possible to be completely symmetric about zero, go to -2, -3, and wherever you need to go to stimulate activity. Yes, there is the reversal rate argument against going to negative, but A, you don't know what the reversal rate is, and B, even if the reversal rate argument were to constrain how deeply negative interest rates can go, this would not necessarily be a fatal argument, because the reversal rate argument applies only to bank financing. And certainly in the US, capital market financing of financial and non-financial institutions is more important than bank financing. So, what's gone wrong? Let's look at the fiscal role of central banks. In the UK, of course, the complex interrelationship between the Treasury, the Debt Management Office, and the Bank of England makes for a very difficult identification of responsibilities of the monetary and the fiscal authorities. In 2018, the bank wisely agreed with the Treasury on capital principles, that they said, and there was some step in the right direction. The bank has to hold capital in line with the bank objectives of maintaining monetary stability and financial stability. This has to be backed by its own capital unless the operations bear a level of risk beyond the tolerance approved by the government and court. I think that last phrase is not there. The bank should not have to hold capital. The entire balance sheet should be backed by, guaranteed by the Treasury. We're a long way from there. I think a significant part of the asset purchase facility is guaranteed by the Treasury, and even with the latest increase in the asset purchase facility, the 100 billion that was recently added, the Treasury will continue to identify the bank and the asset purchase facility for any losses arising in connection or out of this facility. That is a step in the right direction, but it should be extended to the entire facility because nothing is safe. The term funding scheme, it's unclear whether after 2018 there is complete guarantee of identification by the Treasury. Now, in the USA, the mess is much greater. If you look at balance sheet expansion into risky assets, well over $2 trillion, and the risk assumed by the Treasury, it's barely 10% of the maximal amount of risky asset the Fed could put on its balance sheet. So the municipal liquidity facility, the Fed puts in 35 billion of equity, but the facility can make purchases up to 500 billion. That's not even 10%. The Main Street lending program, the Treasury generously puts in 75 billion as equity, but it can lend up to 600 billion. Primary and secondary markets corporate credit facilities. The Treasury puts in 75 billion as equity investment, but it can lend out or hand out up to 750 billion. So you can keep going on, and you soon come to more than 2 trillion exposure to potentially high-risk assets, including asset-backed securities, and with not much more than 10% guaranteed by the Treasury. Again, a direct fiscal and quasi-fiscal role for the central bank, which is not part of its mandate. And I expect things to get worse. Things are even worse, of course, in the euro area, where the ECB's ownership structure and the politics of the euro area make it effectively impossible to provide explicit government-funded fiscal support for the ECB. Well, the ECB is beneficially owned by the 90 national central banks, and each national central bank is beneficially owned by its national sovereign. The way the Bank of England is beneficially owned by the Treasury, the way the Fed is beneficially owned by the US Treasury. But there is no euro area-wide fiscal authority that can guarantee the losses that may be incurred by the ECB as it takes risky exposures. And is it ever? Right? The Pandemic Emergency Purchase Program, PEP, is now capable of extending credit up to 1.35 trillion worth of euros. And none of that is guaranteed by any fiscal authority. So massive credit risk is being taken. Though the facility, the new temporary asset purchase program, will purchase both private and public sector securities. In addition, non-financial commercial paper is now eligible for purchases both under the PEP and under the corporate sector purchase program. Same is true in the US and same is true in the UK. And we really are seeing a constant expansion of the range of eligible assets under the corporate sector purchase program, non-financial commercial paper, asset-backed securities, collateral standards are relaxed. This is a very dangerous world we live in. The Euro system consolidated balance sheet at the end of 2019 was 4.7 trillion euro. By the end of this year, it will be at least 6 trillion, and massive credit risk, both of corporates and of sovereigns, think Italy, think Greece, is being taken in a way that is without legitimacy because it's not part of their mandate. So I welcome, therefore, the attempt that's underway in Europe to substitute for the de facto but non-transparent ECB fiscal policy of the past years, a program of explicit fiscal support worth 750 billion provided by the governments of the 27 EU member states, 500 billion of which is pure transfers. You may disagree with having a EU/Euro area fiscal program, but at least it is transparent and can be discussed and accepted or rejected in a politically legitimate setting. So it is a step in the right direction. And Japan, of course, is the grandfather of it all. It has now a public sector balance sheet. It has a central bank balance sheet, bank balance sheet of over 120% of 2019 GDP. It holds more than 40% of Japanese government bonds, and it holds worth more than 30% of GDP worth of private assets, including equity, private equity funds, or securities backed, asset-backed securities backed by private equity and other risky assets. So central banks are in a place where they ought not to be, and where they will, I think, be pulled back from as soon as this crisis is over, or even earlier, and where they will, I think, lose the discretion over the policy rate, in addition to the ability to expand the size and modify the composition of the balance sheet more or less at will. Thank you.
Thank you very much, Willem. That's another very provocative talk. We can come back to discuss some of the aspects of this, but before we come back and have a discussion, let's go over to Tatiana Kirsanova in Glasgow. Tatiana.
Thank you very much. And I want to continue talk or issues which are raised in Paul Tucker's speech. So there is now a lot of interest to the central bank target, not only to the level of it, but whether it should be 2% or 4%, but to the whole monetary policy framework, whether we should continue with inflation targeting or maybe switch to some kind of what we call delegation scheme. And price level targeting and nominal income targeting are among the favorites. First of all, what's the problem? The problem is that even without COVID-19, there is very little space now for monetary policy to operate. Inflation is targeted from below the target, and the equilibrium real interest rate is very low, so we have a lot of problems. So second, how the delegation scheme can help. Let me say a couple of words about how the whole thing works. I assume that the central bank can credibly communicate the target, but may have difficulty to ensure the overall credibility of its all long-term plans. For example, it cannot communicate credibly the path interest rate is going to take. So central bank, in other words, acts under discretion. There is a lot of empirical evidence that what they do indeed, despite frequent claims that they would rather act under commitment. So under inflation targeting regimes, the central bank communicates the target, private sector knows the target and sets the price. So bygones are bygones here, and if at some point our inflation shoots higher than, for example, 2% inflation target, then we raise interest rate and kill this additional 1%, go back to initial 2% and continue. With price level targeting, bygones are not bygones. And if inflation shoots 3% instead of 2%, we have to keep interest rate for longer and generate deflation of, say, 1%. And only after that, inflation goes back to the price level target. That sounds like horrible policy. And however, if it is credible, then the market participants know that's going to be their fate, and therefore they don't overinflate in the first place. So there is no need to punish. So the whole story about these delegation schemes are somehow related to rational, or maybe not so rational, but forward-looking expectations. So nominal income targeting is based on exactly the same idea. It's based on the same idea, but instead of price level target that governs expectations to a large extent, you also have its combination with output or growth target, either level or change in it, which simply slightly complicates the idea, but not much. So the great advantage of price level target, of course, is that it's based on well-known concept, CPI, and is consistent with dual mandate of all major central banks. So now nominal income targeting basically tells exactly the same, but is conditional on real output, which is much more difficult to measure. It doesn't come in time, and it's not convenient. There is no overall understanding or agreement what the target should be. So with little space for monetary policy to operate, this all sounds wonderful. If we proclaim inflation target which consistent with price level target and inflation target, inflation will jump, interest rates will not, for example, not stay on zero bound. These features of price level targeting or other delegation policies have long been known and recognized. A lot of research was done by the Central Bank of Canada, and predominantly in pre-Great Recession times, mainly with the aim of improving the current monetary policy framework. It has never been tested. There was a hike of interest from the Fed. Charles Evans of Chicago Fed was suggesting to switch to price level targeting in 2011, but Fed has never been serious. So the switch to the price level targeting was and still being discussed, and potential the proponents of that include Ben Bernanke, Lars Svensson, and I can mention many other names. So where do we stand now with these delegation schemes? And now I want to talk about my own research. So first of all, there is an issue with fiscal policy. The debt to GDP ratio is up to 100% and continue rising. So higher level of debt might constrain monetary policy in its reaction to shocks. So as we show in a recent paper with Campbell Lees and Eugene Bai, nominal targeting in an economy with government debt, fiscal policy does not compromise the price level targeting scheme, but there are more problems with nominal income targeting. We show that at debt levels to up to 160% of GDP and maturity between 1 and 8 years, then of course high debt and short maturity result in some issues, but the average maturity of 8 years seems to be relatively immune. So it's absolutely critical, however, that fiscal policy has access to taxes as a policy instrument. We also, it's also interesting to look at this issue in a realistic framework, not only in a theoretical framework, which I've just mentioned. So I have my recent empirical work with Celso Machado and Ana Paula Ribeira, Tight and Loose and Red and Blue, the dance of monetary policy in the United States. We estimate a small-scale model of monetary and fiscal policy interactions in the United States, assuming monetary and fiscal policies are optimizing and non-cooperative. We demonstrate that introduction of the price level targeting while on the zero low bound, for example, in 2011, but it doesn't really matter, would lead a very powerful lift-off from the zero low bound. Inflation would go very quickly up, closer to the targets. There will be no need to keep interest rate below on the zero low bound. This result is also not compromised by fiscal policy. We also show this result under uncertainty. Namely, our model assumes that the central bank is expected to renege on price level targeting in the near future and come back to inflation targeting. So nominal income targeting, of course, will not generate the similar result of liftoff. So the price level targeting, in principle, can be a reusable policy, but it has to be reversed, and it has to be credibly reversed to inflation targeting. But it, in principle, can work as a temporary price level targeting. That's what our research shows. So I want to conclude here. So these delegation schemes remain untested, but they, in principle, look promising, and central banks need to know the range of weapons they can potentially use. These schemes rely on magic of rational expectations, but they can withstand uncertainty. At the very end, rational expectations only allow us to understand certain scenarios, and these scenarios are for sure in an information set of all market participants. Thank you.
Thank you very much, Tatiana. That was, again, another very interesting talk. And last but not least, we're going to go to Roger Farmer. Now, I made a slight error in introducing him earlier. He is at UCLA, but he's also, more importantly, at Warwick University right at the moment. Roger, the floor is yours.
Thank you very much, Chris. It's a great pleasure to be talking here at the Royal Economic Society, particularly in such distinguished company. I'm going to spend the time that I have talking about the idea that fiscal policy, as opposed to monetary policy, is necessary to maintain full employment. But I'm going to talk about a way in which I think that should be operating, which is very close to the way that central banks have been intervening recently in the asset markets. And the distinction has been blurred both in theory and in practice. I'm going to talk about the consolidated central bank and treasury as the state. And a lot of the mechanisms I'm going to be talking about could potentially be implemented at central banks. They could also potentially be implemented by the treasury. There is a great deal of disagreement about the legitimate role of the state. At one end of the spectrum, you have people who argue that the state really has no role whatsoever in public life. At the other, you have individuals who argue that the state should be really intervening in every aspect of both economic and social life. I'm going to take the position that there are two widely accepted roles for the state. One of those is maintaining a stable value for the currency. That's a role that has been typically taken on by central banks. And for the last several decades in many countries throughout the world, it's been operated through some process of interest rate control with an inflation target. The second role for the state is one that really did not exist before the Great Depression. And with Keynes's general theory, it became widely accepted that the state also has a role in maintaining high full employment and potentially also growth in living standards of the average citizen. I'm going to argue that the state should continue its role of maintaining the value of the currency, and that could be through price level targeting, inflation targeting, nominal GDP targeting. There have been a variety of discussions that Tatiana talked about just now. I'm not particularly concerned about which mechanism is used. My own view is that the move to inflation targeting, which has occurred at various points over the last few decades in many Western countries, was an enormous success in bringing about the reduction of inflation. I'm much more interested in the second role, which is sometimes partially adopted by central banks in some countries. There's been a lot of discussion in the public sphere about the absence of fiscal policy. Some of the people talking earlier today have mentioned that there may be less fiscal space than there was at one point. So my view is that fiscal policy is important at maintaining full and stable employment, but it should be operated not in the goods markets, but in the asset markets. And in particular, I'm going to talk about an idea that I first introduced in my book, Prosperity for All, a few years back. And that is the idea that the state should set up a sovereign wealth fund. And the purpose of this institution would be to enact what is essentially a fiscal policy. So let me talk a little bit about how I see that would work. And then I'll try to discuss what the operation of that entity would look like in the wake of a financial crisis, or indeed something like the coronavirus crisis that we're going through now. So first of all, I would argue that the state and possibly operationalized through some entity, possibly the Bank of England, possibly a new institution, operated by some group of people, possibly the Financial Policy Committee or something similar. And this institution would initially borrow something like, I would argue, 200 billion would be not a bad starting point in the UK context. And that would occur through the issuance, I would argue, for long-term consols, which are really, the government can borrow very cheaply long-term in the current climate. The state operating through this entity would then purchase equities, but not any equities. The steps to be taken to do this would be as follows. I would argue, first of all, that one should define what objects that this new entity would be willing to trade. It should consist of a very broad-based exchange-traded fund in the entire set of publicly traded assets. It would be exchanged, it would be market-weighted, so that the share of individual companies was not determined by the FPC, it would be determined by private individuals. And hopefully it would contain mainly non-voting shares. When the MPC meets, the committee or entity that would be operating the fund, potentially the FPC, would announce at the same time a price path and a price level for the current value of the exchange traded fund. So an example would be if, for example, we'd been in a situation, say, just before the great financial crisis, and the ETF was trading at 100, and post-crisis, it began trading at, say, 70, the FPC would meet and they would say, well, we think it should actually be trading at 95. And as of next Thursday, this ETF will be trading at 95. Now, if the announcement is credible, and I have every reason to suppose it would be, that gives an incentive to private individuals in markets to go out and to buy up the underlying stocks that make up the ETF and to bid them up in such a way that the value of the index becomes equal to 95, even without the intervention or the buying and selling of assets by the committee itself. Now, I think it's important to ask why the policy I'm suggesting might be a good idea. The entire framework for thinking about monetary policy that we currently operate in dates back pretty much to 1968 with Milton Friedman's presidential address to the American Economics Association, where Friedman argued that central banks can control inflation, but there's really not much they can do at all about real economic activity. Now, in Friedman's view, and in the view of almost all the economics profession since then, with the exception perhaps of the post-Keynesians, it was accepted that the economy is self-stabilizing, that there's a natural rate of unemployment, and that the economy moves rapidly back to that. That idea, I think, is entirely false, and it misses the main ideas that we learned from Keynes's general theory. And in practice, there is a very strong connection between wealth in the asset markets and employment or unemployment 2-3 months later. So the reasoning behind the arguments I'm putting forward are that consumption, which is roughly 2/3 of the economy, is driven not by income, but by wealth. That wealth, to the extent that it can be influenced by government agencies, is amenable to operations in the financial markets of the kind that I've discussed. And finally, arguments that I don't have time to discuss here, but I do discuss in depth in my book. The financial markets themselves are, in my view, inefficient because of the absence of complete markets through time, and that interventions of the kind that I've discussed are likely to be much more effective at maintaining what is widely now perceived to be a second goal of the state, which is maintaining a relatively low unemployment rate. So having said that, I think I've been provocative enough to put some things into the discussion in general, and I'll hand over here.
Thank you very much, Roger. If actually the organisers could actually open my video again now, then maybe if we're going to have we've got 20 minutes or so for questions, which I think is ample time to get into this session. I mean, if I was going to summarize the 4 talks, all of which were very, very good, very, very briefly, I would say that Paul Tucker was essentially saying that, particularly in the UK, central bank independence is at the moment pretty much over. William Bouter was saying that what central banks have been doing in the crisis, particularly in the US and the Eurozone, is very dangerous, and they've been playing around with, fire. Tatiana was saying that central banks can get us out of the economic hole that we're in, particularly if we impose price level targeting. And Roger Farmer came up with the argument that fiscal policy is what should really be operating as well, the cyclical balancing of the economy, but not through the current way of purchasing goods, but purchasing assets. Now, I will go to your questions in a second. We've got 1 or 2 coming up on the chat. But I just wanted to, first of all, ask Paul a question relating to your talk. I'm going to ask a question, I think, for each of the panelists. Paul, when you made a provocative point that, that particularly in the UK, the Bank of England is now just the operational arm of the Treasury, and it's been essentially doing its bidding from Horse Guard Parade. That might or might not be the case, and you made a strong argument why it is the case, particularly the timing, which I think is a very strong. A lot of people say, well, isn't that a good thing? Is that a good thing or a bad thing? Hasn't the policy actually been quite effective so far?
So, first of all, to be clear, I'm not saying it's definitely the case. I'm saying that if the intention is that independence is sustained, then the bank and its committees and the Treasury need to be very careful to communicate in ways consistent with that. And also for the actions they take to be the actions the Bank of England take, to be clearly and explicably justified in terms of their statutory mandate. And so I can't see inside their souls. Independence may remain intact and the integrity of their decision-taking remain intact too, which I very much hope is the case. My underlying point actually, and this is a point I make in my book, is that were independence to be sustained, then as a matter of political economy and actually political morality, I think it's important that we're told. And if they were to think, if the government of the day were to think that would be too risky, my response would be, actually they would discover, if they were embarked on this course, that it will be equally risky to have fudged the matter. And you know, there have been just some communications things, what these people call comms, communications things, where just a little bit more care would have kept these concerns, which I think I'm reflecting rather than necessarily subscribing to, at bay. But you know, deep down in terms of our political morality, if this institution is independent under statute, and if the Treasury have not exercised their power to suspend its independence, then it is very important that it should look and explain itself in terms of its mandate. And I think that hasn't always been easy over the last few months.
Just to follow up on that, last week at its monetary policy meeting, the Bank of England did announce another 100 billion of QE, so going to create another 100 billion pounds and essentially buy government bonds with that. But equally, it also slowed the pace of purchasing.
Yeah, that was quite significant, I think.
Was that a show of independence there?
I don't know. I hope it was just what they genuinely thought was necessary in order to meet the inflation target in 2 to 3 years' time. That would be the only. They shouldn't do anything to demonstrate independence. They should do what Parliament has mandated and ordered them to do. But it's certainly something that has attracted some comment, because as you and many of the viewers will know, it happens to be the case that over the previous couple of months, the path of gilt purchases by the bank tracks almost exactly the path of gilt issuance by the government. And speaking as someone who was the government debt manager when it was in the Bank of England, and somebody who ran the OMOs, and somebody who was on the Monetary Policy Committee, those are circumstances where the communications need to be absolutely immaculate to dispel the suspicions, which have been pretty rampant upon part of the analytical community. And so what I'm using this for isn't to say I agree with all of that. It's to convey a message to them from an experienced friend that this is something that they need to be very attentive to. And I'll give one tiny example, if I may, Chris. The letter on ways and means which said, I mean, I think I was in charge of the Ways and Means account a long time ago. That would have been a better press release if it had said two things in the notes to editors, to people like you. One, the Monetary Policy Committee is of course under legislation empowered to offset any monetary effects if they think they are inconsistent with the statutory mandate, including in the limit saying no to the overdraft. And also, in those circumstances, the Treasury is empowered by Parliament to overrule the bank. And I think that kind of just, we know what the framework is, we're reminding people what the framework is the kind of care actually, which at the beginning of 2009, Mervyn and I and Charlie were kind of assiduous with Alistair Darling and Gordon Brown about the rules of the game and what was for us and what was for them as we embarked on QE. So my point really is a plea for more care.
What do you think is at risk if we don't have that care you're asking for?
Oh, I think in the limit it would be rating agency action. I don't think trying to be clever, and I worry that some of these, the debate apparently coordinated in favor of nominal GDP targeting. I'm not at all convinced that has anything to do with, or much to do with, improving the underlying functioning of the economy, because it's not obvious that nominal GDP targeting would raise the rate of underlying productivity growth, which is the great issue that our economy, amongst other Western economies, confronts. But that debate can be portrayed, and has already been portrayed amongst commentators, oh, this is to do with subordinating price stability to something a little bit more exuberant. I mean, behind this lies a desire, which is, I think, completely understandable, which is that the government will be very concerned, not certain, but concerned about the public finances, not because fiscal space is definitely exhausted, but because no one knows what will happen over the next few years. And those are the circumstances in which financial repression, keeping rates low, is attractive. So when the debate about negative interest rates came up, where I think the Bank of England said, no, we're not going to do negative rates. And then they said, well, actually, we're going to have a review of negative interest rates. My second thought, my first thought was, well, that's exactly what you would, if you were the Treasury, you would want the bank to have a review, even if the bank was headed in super slow motion to concluding it wasn't doing negative rates, because in the meantime, it would hold down the gilt yield curve during a period when the government has absolutely masses of funding to do. As I say, I'm sympathetic to that. By the standards of the time, I did masses of funding for the government in the mid-1990s. But the only way of keeping true to your underlying principles is to be open about all of this and not to try and be too clever with the design of the regime. I mean, the faddishness of the Treasury, the old Treasury during the 1980s, narrow money targeting, broad money targeting, mixed money targeting, then not targeting anything. I mean, this was a world where the regime shifted around, not just according to the economics, but according to the politics. And the monetary targets were set, the assumptions about the velocity of money were made, not just according to information that people had at the two ends of town about perturbations in the demand for money, but also in terms of what would be helpful. And no one should think that if it's a more complex target that involves judgments about underlying growth or cyclical growth, that even if it starts off pure in spirit, which is what I would expect, it would be vulnerable to being distorted as politicians find themselves in the corners that, democratic politics, which I fervently believe in, democratic politics delivers, unleashes upon them.
Thank you. Willem, I wanted to come back to you. You said that central banks are in a place they ought not to be and will be pulled back from. It's a similar question, the first one to Paul. That might be the case, but would it be worse if they weren't in the position now, if they hadn't acted as they did in this crisis?
Well, they may have acted the right way, but that still doesn't make it legitimate. Right? I do think that certainly the Fed and up to June 17th, the Bank of England responded largely in the right way to this financial crisis by expanding the balance sheet and changing the composition towards less liquid and riskier assets. But it remains illegitimate. This is not the task of the central bank. There is a clear fiscal dimension to that has to be approved and mandated by Parliament or by the US parliamentary structure. So no, I was disappointed to see the Bank of England maintain bank rate at 0.1%, not engage in yield curve control, and go for a miserable 100 billion extra funding. But the composition, the content is one thing, the procedure by which this is implemented is simply illegitimate. This is not the job of the central bank. The size and composition of its balance sheet have to be mandated by or agreed by the Treasury with a full guarantee for the entire balance sheet.
And so is it the legitimacy of central banks and of independent organizations that ultimately is your big concern?
Well, no, yes, in a way, I am simply concerned that what Roger called the state, the consolidated Treasury and central bank, right, does a job that is both effective and legitimate. On effectiveness, things haven't been too bad up to recently in England, in the UK. In terms of legitimacy, I think it's a complete blowout. Something that would not be helped, of course, by the state creating a sovereign wealth fund, the way Roger said, because again, the management of that fund, the composition of the assets, the guarantee of the risk taken has to be clearly Treasury business. So the state should not be shorthand for this kind of central bank doing its own.
Yes, I agree. I agree.
The approval of the Treasury.
That's very
And I
interesting.
would actually, the one thing I would have against this proposal of the sovereign wealth fund is that if it's only invested in market traded equity, you leave out the small corporations and the households. So good small corporations may be helped by loans that are convertible into equity, but it wouldn't be market based. And for households, of course, I think direct transfer payments, tax cuts are the only way to provide financial support, COVID-type financial support. And of course, I would argue there are circumstances under which enhanced public spending on real goods and services, infrastructure and whatnot, are an essential part of the package.
Well, do you want to answer that?
Can I just quickly step in there? So, in response to both of those, both Paul and Willem, a lot of the discussion has been in terms of what's legitimate under the current rules of the game. I think we're at a situation where society is thinking very clearly about changing the rules of the game. Mm-hmm. The point Willem made about the broad base, how broad the wealth base is completely correct. And in the UK in particular, housing is extraordinarily important. And exactly what is controlled in terms of the base of wealth, I think is completely open for discussion. In terms of, however, moving forward, I think it's extraordinarily important that both fiscal and monetary policy are put on the basis of an institution as opposed to being one-off and at the mercy of the political winds. And what I'm exactly suggesting is that some version of fiscal policy in the asset markets, which is what Willem has been railing against in terms of the way that it's been somewhat arbitrary so far, should be put onto the same footing with political control as monetary policy is. some degree of independence for whatever committee would operate. This is, I think, an extraordinarily good idea, but it's also extraordinarily important that the members of that committee are rotated on a regular basis, much in the same way that the MPC members are. And indeed, I think the model for this would be, say, the Supreme Court in the United States, maybe with shorter terms, but certainly some level of independence.
Paul, you wanted to come back on.
Well, I merely wanted to say that behind these questions about the legitimacy of independent central banks lie a whole set of higher level questions, which I think are the ones that really matter about the legitimacy of unelected power. So in terms of Roger's idea, say it's got substantive merits. And remember that economists typically think about a world in which a social planner can do good, whereas constitutional theorists have taught us that actually to think about a malign sovereign who will do bad. And so the risk is, if it's under day-to-day political control, the politicians will sooner or later start choosing districts or firms or whatever cohorts that matter to their electoral prospects. If, on the other hand, they give it to unelected people, it's really important that the unelected people aren't able to say, and I think this goes to Willem's points about the Fed, oh, let's help the hotel industry, or shall we help the North rather than the
Precisely
South?
why I'm arguing for an ETF.
Well, even then, somebody has to decide what the index is, and there are issues. So I'm not saying it can't be done, but Britain has become immensely careless about the design of these agencies.
One of the questions in the chat has been whether this should be a general index fund if you were to go ahead, or should it be concentrated on environmental and social goals, or is that where you get into this really difficult question about?
It's a completely separate issue. There is a legitimate role for government in thinking about the environment, in thinking about redistribution, in thinking about industrial policy, but those are separate policies from what I would take to be the implementation of fiscal policy.
Thank you. I want to go back to Tatiana, we've got about 3 minutes left. Tatiana, you talked about the strength and power you could have in a price level target. I just wanted you to just address the comments that Paul made right in his talk about differences between targets and then the implementation of those targets, or the instruments that central banks have. And would your target be effective even if central bank didn't have the instrument?
But there is no big difference between inflation target and price level target in this case. So as Paul said, it doesn't require you to have a new instrument. So the instrument which works here is expectations. It's expectational communicational channel here. And that everyone has to be careful, of course. We use these models with rational expectations for ages, and we are afraid to use them when the time comes. So we trust the results which they generate, but when we are asked to use them in policies, we are hesitant. So because price level targeting utilizes property of rational expectations, that's tricky. But on the other hand, as I said, our research shows that if you add uncertainty, that it still should work. And unless we test it, we don't know.
Paul, do you want to respond to that?
I just think, of course expectations matter. That's why the design of regimes matter, but hydraulics matter too. The example I used to use within the Bank of England, I'm going to give a slightly different version of it now, is that imagine that
Be quick, Paul, we've only got a minute.
Okay, imagine that the governor goes onto the steps of the Bank of England each week and does an inflation dance in order to generate inflation. So that's something that she or he is committed to for years. I don't think this will make any difference to inflation whatsoever because there'll be no hydraulic effect.
Good, right, I think we are going to have to wrap it up there. I'm sorry, there's a really stimulating discussion and we could have gone on for ages. Next week, the next RES webinar is on about households in lockdown, but I think I've just got time to say thank you ever so much to Roger, Willem, Paul and Tatiana. It's been a fantastic discussion. Thank you very much.